Hello, folks. We're going to continue on with our series with what's happening in banking worldwide, especially linked to what's happening in the banking in the US, Silicon Valley Bank, Signature, and all of that. And so, before we even go into that, I want to think about what is some basic ideas about banking. A lot of banking happens this one simple idea called as fractional reserve banking. Like very simple. Banks take deposits and then they give out loans. So, if banks take deposits of 100 rupees or $100, they give out loans for less than that, 80 or 90. These find their way into the economy. They probably become deposits in some other bank, and they give out loans for a fraction of that. So the banks make money on what is called as a spread. They take in deposits and pay interest rate. They give out loans and collect interest. The difference in the rates is the fundamental idea of banking. So bank might give you 3% for deposit and charge you 9% for an education loan, 12% for automobile loan. So if that difference is where they make their money at. And so very simple idea. But if they take 100 of deposits, they don't lend out 100. They sometimes lend out 80, sometimes lend out 75, sometimes they lend out 90. That depends on several reserves and what the regulatory environment is. But fundamentally, they take 100 of deposit, they lend out less than this. Right? Nice. When I was growing up, I never understood some of the terms. One term that used to continuously get confused with. Let's say we bought debt, we bought treasury. And what does it mean? Giving loan is the same as buying debt. A very important point, I never got this. When I was growing up and I was studying, it used to throw me off guard. So I'm assuming that some of you also don't get it, maybe all of you get it, I'm just making the assumption. But that aside, if you or I go borrow from the bank and say, look, hey, I want to take a loan for 25 lakhs to make sure that I can complete my MBA I can pay my MBA fees. And then the bank is lending to you. They're borrowing money from the bank. That's how we'll call it. Right? If the government of India borrows, right, that means the government of India will give out paper that banks will buy. And so government securities. So banks buy this security and government will pay coupons for this. The same, like the banks are lending money to the government and getting interest payments. Instead of that, the government is selling it paper, or lieu of which it will give coupons. And so it's the same idea, but giving a loan and buying debt are same. And so I thought giving a loan was one type of transaction, buying debt was another type of transaction. Right? They're both the same. Right? What does buying debt makes out of this is creates a nice financial transferability to this loan. That is, if you have borrowed from your friend Ram, you borrowed 25 lakhs to complete an MBA. And then Ram says, dude, I'm running off. I'm going to the US. I'm going to start up a business there. No way you can repay it to me. I've taken it from my friend John. So you repay the 25 lakhs to him. So it transfers that debt to him. I've taken it from him. You make sure you repay him. And so something very similar happens when you're buying debt. So suppose you're buying government securities. That means effectively the government has borrowed from you. Right? You can sell the security. So what the government owes you will now be given to somebody else. And so that is the loan becomes transferable. If it's a term like this, it is less transferable if it's a loan. Among friends it's possible, but you can't say, look, I borrowed 25 lakhs from Punjab National Bank and you tell Punjab National Bank, good, but you take it from my brother. No, it doesn't work like that. You have to do the repaying. It's not transferable that easily. Whereas if it is a paper trail, this is transferable. That difference is there, but effectively both are same. So very, very important to understand this. The government taking a loan from us or us buying government security are both the same. You buy government security. That is, you pay money and get an IOU from the government. That money, the government is taken from you, which it will repay. It's a loan. What we call a loan is also called as buying government security. Very important definition-wise understanding this. In finance, lots of times, the guys who know some of these things or half know some of these things intimidate the crap out of the rest of us by using all kinds of jargon. And I don't want to be intimidated. Right? So let's go back. Continue with our theory. And how does banking happen? A very beautifully important thing. Banking happens by banks collect deposits from people, all kinds of fixed deposits, and then they loan it out. They hold some part in securities, some part in cash, some other categories, whatever these are. The system says if you have a loan base of 88, 90, then you should, or deposit base of 88, 90, then you can give a loan base less than that. I cannot have deposits worth 100 crore and lend out 140 crores. Then I have an issue. I don't have money to lend out. I'll be borrowing from somewhere else. That causes trouble. Right? So your deposit base, from that you have a loan base. Why should this be lower? Because think about it. Some of my depositors might come back and say, look, I'm sending my son to do his MBA. I put 25 lakhs. Give me the 25 lakhs. And so that can cost. So I need to have money to give. Some money I might need immediately. That is cash. Some I need for giving. I might have it be invested in government securities that I can sell and give over a 2-year, 3-year horizon. That goes here. Loan also I'll collect. Not like I'm giving away a loan. Right? I'll collect, but this loan I may not be immediately able to collect. So I might have given a housing loan to someone for 1.3 crores, which they promised to repay over 15 years. You come back and ask your 25 lakhs from me. I cannot tell that guy, dude, sorry, guy has asked me 25 lakhs, you give me back. That guy is building his house. He can't repay. And so this is not immediate. These are immediate. Right? All banks have a buffer. It's their net worth or equity. And so the government mandates how much buffer they should keep. This is what the bank is worth. The bank is doing really well. This will keep growing. If something happens, this can crash. And when can it crash? When something goes wrong here. When can something go wrong here? I have lent 4,000 crore to a fancy airline which I don't see the money, and the guy who ran the airline company has gone outside India and sitting somewhere else. This loan disappears. Then this shrinks. Then that will disappear first. I cannot say I will not give my deposits back. My equity will go. So if I have bad loans sitting here, more than how much profits I generate, it will erode my equity. Every year I make more profit, this will increase. My profit adds up to this. If suddenly I have more bad loans, this will start shrinking. So 1 or 2 bad loans can kill this. Right? Even otherwise, banks are built on what is called as a confidence trick. What is that confidence trick? All these depositors are happy and content that their money will come back. Very few times will you withdraw money because you're afraid the bank won't give it back. You withdraw because you need it. Right? What can happen sometimes is suddenly a bunch of people want their money. If 10% want their money, I have cash. If 20% want their money, I have cash and some securities. If 40% want their money, I'm in trouble. And so sometimes it can show up. When will 40% want their money? When their people are worried. When they are worried that this is going to zero or something is wrong with the bank, some scandal is happening, then that's called a bank run. So even in a fully properly functional bank, if there is a run, if lots of people all of a sudden want to take their money out, any bank will be in trouble. If this goes off, if one day 40% of all deposits of any bank, all depositors of any bank say, look, over the next week we want to take our money out, bank is in trouble. This shrinks by 40, somewhere this has to shrink. Every bank will have cash, every bank will have securities, every bank will have a line to the government or to the central bank to say, give me some liquidity. Suddenly I have a deposit issue. All good. But all of those are 1 day, 2 day fixes for small numbers. If 40% disappears from here, you are in trouble. Which is why a bank run is a serious problem. Whenever a bank run happens, the central bank steps in and says, don't worry, I'm giving you liquidity. I'll keep giving you money, you pay that, you pay me interest. Instead of deposits, it is my money. So I balance the two things. And I'll come and tell people that, hey, don't worry, this bank is sustainable because I am sitting here, not this alpha bank, but me, central bank. I am sitting here. I'll make sure that the money is better. So the people who are running away with their money, they say, no, I don't have to worry. That's where the central banks come into the picture. Your RBIs of the world, right? Which is why they say, if I need to step in at some point of time, then you have no business running full freedom, laissez-faire, open economics in your thing. If I have to come here to bail you out, I'm the lender of last resort. I'm the guy who comes in and cleans up. It is my job to be the backstop for this entire system. Then you bloody well follow my rules when I say whom you're lending to, how much oopsie, how much securities you have, what cash you need to have, all of that. So, which is why banks are regulated, which is why banks need to be regulated, which is why the regulators have to have super high freedom. Super important. So, it's a very beautiful system, but a slightly fragile system. Right? So when can this go bust? This can go bust if there are bad loans, there's a bank run. Usually the two are linked. If I hear of a bank run, bad loan, then I worry this will go to zero. If this goes to zero, then the guy who's running the bank, he has got nothing left. Why will he honor anything? I'll say, look, the guy has no stake in it. I'm running, I'll take this and run. Right? So if I have a fear of bank run, then I'll go run. I don't know anything about this. 3 of my friends are going to the bank to withdraw money, I'll run with them. Because I want to be the first to take out money from the system, among the first to take out money from the system and run. What does the central bank do? It gives confidence about this. It gives liquidity here. It reassures depositors there. That's their job. So that's how whenever a banking system becomes fragile, central bank comes in and says, look, you're not dealing with them, you're dealing with me. What happened in Silicon Valley Bank is very interesting point. So generally, if you look at this, these are unsafe, or if you have lent to people, their business can go wrong, the economic cycle can turn. This is cash, super safe. This is securities, usually government securities, super safe. What happened in Silicon Valley Bank's case is super interesting. They had lots of deposits. This flew. And they used to deal with all these tech companies. And they were flush with cash. Why? Because they were funded to the gills. They were the ones putting the deposits. So Silicon Valley Bank, very, very interestingly, this loan book was very small. The securities was very big. So they had a mechanism where they didn't have to lend too much to people. They just bought securities. So you would have thought, beautiful, this is safer than a normal bank. They're not giving out that many loans. Why will the loans go bad? And so it's almost inverted. Their loan is 20, their security is 54. That much. They had tons of money put in government securities. And what can go wrong with government security? They're super safe, right? Super safe. Nothing to worry about. Right? So brilliant. This is going on fine. Except what happened in the US is the interest rates went up. What do you mean by government security? If government says, suppose the government says the renting rate is 2%. You buy a 10-year, 1,000 crore bond. Every year you'll get 2%. 20 crores, 20 crores, 20 crores, 20 crores. The 10th year you'll get your 1,000 crores back and 1,020. On your book, you have lent 1,000 crores. Over the next 10 years, you'll get 20, 20, 20, 20, 20. The 10th year, you'll get 1,020. Beautiful. What happens if interest rates go up? Yes. Suppose interest rates are at 6%. Right? That means you give 1,000 crores. You get 60 crores, 60 crores, 60 crores, 60 crores for 10 years. And in the 10th year, you get 1,060 crores. Brilliant. Now think about this. Suppose I am Silicon Valley Bank and I've given out this last year, and now the government is giving this. Think about this. This is way more valuable than this. And understand that there is a mechanism to buy and sell debt. Like we discussed, we said, look, it is not like giving loan but buying debt. So if you imagine you are an external investor and this is available for 1,000 crores, this is available for 1,000 crores. No way is that even possible. This is way more valuable than this. In other words, if this is selling at 1,000 crores, what do I mean selling at 1,000 crores? That is, I can buy this paper for 1,000 crores. What does that paper guarantee me? It gives me 60, 60, 60, 60 for 9 years, 60 for the 10th year plus 1,000 crores back. If I'm buying this for 1,000, I'll say, dude, I can't give you 1,000 for this. For 1,000, I'm getting that. I'll give you 880 for this, 900 for this, 850 for this, which is nice, which is how it's supposed to work. And so this is a juicier paper than this. Again, understandable. What happened when interest rates went up? Yes, quite beautifully for the likes of Silicon Valley Bank. This securities part, the value of that thing shrank. And so started shrinking, which again, per se, is not a problem because this beautiful second idea, realized losses without mark-to-market losses. Right? So, what do you mean by this? Suppose I have bought this paper, beautiful paper. If I bought this and the market is selling this, then this is not worth much. I have bought this for 1,000, but today it's worth only 860. But that does not mean I have made loss of 140. Both are notional. It's like saying, suppose you buy a house and you buy a beautiful flat for 1.4 crores. Nice. And then 2 years later, it is worth 1.8 crores. The government cannot come and say, you made 40 lakhs, pay big taxes on that. No, you've not sold it, you have it. Suppose you bought it for 1.2, 2 years later, because of some flooding in the area, it's worth only 1 crore. It's not like you've lost 20 lakhs. The house is yours, the payment has been made. I don't need to kind of make this loss appear on paper clear. I sell it, then the loss happens or the profit happens. Otherwise, there's no mechanism to do this. Right? So the banks are still functional, all good. Right? So this could have happened, and Silicon Valley Bank could have still said, look, how does it matter? I have this, I'll get this interest. And with this interest, I can still fulfill all my obligations. My deposit, I'm paying a lower interest than this 2%. What's the problem? Right? So they may not be hugely profitable, but how does it matter? Why do I need to mark to market? What happened, interestingly, is they had a bunch of issues where people took out their deposits. They had to fill the gap. And then you fill the gap by saying, look, I will either raise equity or say, look, I'm coming back, I'm taking money from my original owners, making my equity buffer higher. Or I give away cash. The cash buffers were very low. Cash buffers need not be high. Or if I have to plug the gap, I sell some securities. If you sell securities, then the losses become rectified. I have a house worth 1.2. It is now worth only 1 crore. I am living in it. I am very happy. Some pressure I have to conduct this wedding. So I sell the house for 1 crore. Then the loss happens. So that's what happened. So very beautifully, it reached a point where, I shouldn't use the word beautifully, I'm saying conceptually beautifully. I'm not saying the fact that Silicon Valley Bank crashed is beautiful. It reached a point where the mark-to-market part was no longer mark-to-market, but some part of it was realized. After that, the genie is out of the bag. If I say, hey, I need to make sure that my equity buffers are retained, so I'm raising some more equity. Immediately people will say, your equity buffer? Oh, फिर तो कुछ problem है, something is wrong. I'll take my cash out, then I'll worry. Suddenly a bank that's fully functional will not go and say, I need to improve my equity buffers. That's a bad signal. They sell some part of their portfolio at depressed prices, then that's a bad signal. It's a confidence trick. Anytime there's a bad signal, we'll run and say, hey, this is not something that I can bear. Let me take my money out. And as I said, it's a confidence trick. More people take their money out, the more vulnerable your system becomes, the more trouble we have. And so this delicate balance has to be maintained. Usually, whenever banks get in trouble, it's because of this. This time, banks got in trouble because of this. Because this was worth some amount, because interest rate changed, it became worth less. Which is why the banks are supposed to hedge their portfolio and say, look, I have to match this, I have to make sure that I don't carry interest rate risk. Silicon Valley Bank did none of this. Silicon Valley Bank basically said, look, I have a business to run. This side is the one where I have to be super safe. That's just deposits. I have that. Per se, if I think about it, cash is safe, securities are safe, loans are less safe. I'm not giving out any loans. What kind of risk could I carry? Securities are super safe. Except securities are safe. The government will honor its debt. They're not going to default and say, look, I won't give you money. But it can get readjusted if interest rates go up. That happened. Now the obvious next question is, okay, so how many other banks are like this? A great many are like this. The government has opened the purse strings and issued a lot of debt. If government issues debt, somebody is buying it. That somebody is generally not you and I, some bank. So lots of American banks have this, which means a lot of them are sitting on a ton of unrealized losses. The banking system is functional and happy and robust. It won't matter, it'll unwind. But if they have to sell, then they become recognized losses. It's loss. They've sold the house and it's a loss. Then there is trouble. Or they have to improve their equity. So over time, the banking system is going to have to figure out a mechanism to say, this big chunk here, which had actually grown in share, has now lost value also. Now, that loss of value has to be compensated. Over time with profit, this buffer can go. Lots of them can raise equity and this can come up. In the meanwhile, the government has to come in and say, look, I will make sure that this is safe. The moment this becomes unsafe, it causes more trouble. Already, tons of amount of money have gone from small banks to really big banks. What are considered systemically crucial banks, too big to fail banks. So, if there's a small bank in the US, then you can take it for granted that this number has already fallen by on an average 10 to 15% for all small banks. Everybody is worried. So they're saying, look, all good, the government will step in, let me take my money and put it with the large fellow there. And so this has shrunk and is shrinking. The more this shrinks, the more this goes out of whack. If few banks go bust and they're forced to sell this or forced to look to raise this, there is more trouble. Which is why the government is looking for somebody to come in and say, systemically, these are important, they're sustainable. Somebody comes in and buys a bunch of this. This buffer will come, that will give the confidence. That confidence trick can kick everything back and they're trying to do it. Till then, they're saying, I'll be the backstop. Deposits, I'll backstop. Liquidity, I'll provide. This securities, I'll see what can happen. So there's pressure on the US to lower interest rates, because if they lower interest rate, this portfolio automatically improves. That might fix the gap. And so, but there's a super delicate balance. And for the beauty, or again, beauty is probably the wrong adjective, the most crucial part in this bank problem is that this time the bank run problem did not come from the loan portfolio, it came from the securities portfolio. That is super crucial, because now this gap is going to be across the board. And the moment that this gap is there across the board and there's a fear that can get realized, then these people are going to run even more. So it's a nice, delicate situation. The US equivalent of finance minister and RBI governor, US equivalent of that, Janet Yellen and Jerome Powell, both of them are coming in and saying, we will provide the backstop, don't worry. Without explicitly saying that deposits to any amount will be insured. You don't want to say that. Then that causes moral hazard and all kinds of things. They're saying, look, there is a backstop here, it is not a systemic crisis. But the problem is, whenever there's a confidence crisis, the big backstop has to come and say everything is fine. People are now saying, what else will you say? If the moment the equivalent of RBI governor says, I don't know, maybe there's systemically some problem, more people will run. So even if the decks are, the whole house is on fire, person has to come and say, we will stop this, we will provide a balance. But the moment the confidence goes out, the whole thing is rattling to a crash. So it's a beautiful, delicate thing. What are the implications for India? There could be if this has broader contagion, the European bank 1 or 2, Credit Suisse has failed, has broader contagion, then finance markets everywhere could be in trouble. Finance is a delicate confidence trick. Indian economy, banking system, NPA, all those metrics are by and large fine. But there could be a temptation for hyper safe Indian depositors to say, hey, okay, all good, but I'm not dealing with the small banks in India. If the banking system at some point of time becomes vulnerable, the banking insurance for India is not as high as the US. I think it's 5 lakhs. So many people have more than 5 lakhs. So they'll probably say, look, I'll put most of my deposits in the systemically stable banks. It's a pain, because distributed banking is one of the cornerstones for growth. If India had only 5 banks and only those branches, they would really struggle. There are small towns which are banked by none of the big banks. And these small banks therefore need to survive. They're doing a good job. But when fear comes and grips, then if this gets eroded for a bunch of small banks, we could be in trouble. I don't think there's anything which is direct contagion for India. We don't have any exposure to any of these. We don't have to worry about the counterparty risk, any of that. But if the mood changes against small banks, that's something that every country in the world has to worry about, because people can think, if a small bank in the US can go bust overnight, why do I have to put money in my cooperative society bank? Why don't I take it and put it in SBI? The moment you do that, it causes a lot of trouble for the economy. And so the confidence being maintained is super crucial. I don't think there is any particular implication for India, but we have to make sure that the confidence is maintained. Right? Lovely. Best wishes for CAT preparation. Enjoy your preparation.